Okay, folks, welcome to Chapter 4, Conclusion. This is Part 2, and we'll be done in a very short amount of time here. So what this slide shows is really just a summary of what we completed in the last slides, right? These are the 4 steps for closing out our temporary accounts into the owner's equity account. So let's take a look here. Remember, we had expense accounts. Let's start with revenue. We had revenue accounts with credit balances in them. We debited those revenue accounts and credited the income summary for the total of those revenues, thereby moving the revenue into the income summary account. We also had a bunch of expense accounts. All of the expense accounts had debit balances in them, of course. We credited the expense accounts the full amount to make them zero balances, and took the total and debited income summary for that total amount, thereby moving the expense amounts into the income summary. Therefore, we summarized all the revenue and all the expenses in this one account called income summary, right? That left us with a balance of $3,785 credit balance. That's the net income shown there. So the next step is to close this account, right? So to do that, we do the opposite of whatever's in there. If there's a credit balance, we debit it, which is what we did here. Debited income summary for $3,785, and the other half of that, whatever it is, a debit or a credit, goes to the other side of that journal entry, goes to owner's capital, right? In this case, it was income, it was a credit balance, so we debited income summary and credit the owner capital account. See what I mean by moving it, right? We had a $3,785 credit in income summary. Now we've got that $3,785 credit to the owner's equity account, thereby increasing the owner's equity account by $3,785, the net income for the last period. And the last step is just to go see if the owner had any withdrawals, thereby reducing his account. And he did this period. He had $200 withdrawals, shown by the $200 debit balance that's in his withdrawals account. So we need to make that account zero, and we do that by crediting the owner withdrawals account and moving that into the owner equity account, showing a debit there, which would of course decrease his total equity by $200. And this shows that magic slide that we've been working with the entire time, right? Basically the accounting equation. Assets is equal to liabilities plus everything that makes up equity. But I want to focus on these things. Assets, liabilities, and the owner capital account are permanent accounts that we will never close to zero. Everything else, the other equity accounts, the owner withdrawals, the revenues, and the expenses, these are the temporary accounts that we close. And again, when I say close, I mean get them to a zero balance. If there's a $10,000 credit balance in revenues, we need to debit it $10,000. All of the expense accounts, if there's $500 debit balance in one and a $600 debit balance in the other, we need to credit them $500 and $600 respectfully. Get them all to zero amounts in the revenues expenses, move them into that income summary account, then close the income summary into owner's capital, and then close owner withdrawals into owner capital as well. The last step here is, of course, to do a post-closing trial balance. So we want to just list all the accounts and what's the final balance after we have closed the temporary accounts. Total debits and total credits must still be equal. So this is what it looked like before when we started this chapter. If you go back and take a look at one of the first slides, you'll see a trial balance with all of the accounts, including the temporary accounts, which is from here, here, and everything below it, right? The withdrawals, revenues, and the expenses. And this will be identical except for the fact that our withdrawals, our revenues, and our expense accounts properly show a zero balance, which is exactly what we want. We want them to be zeros. The only difference, of course, with the permanent accounts is we've closed all of these amounts, the revenues, expenses, and withdrawals, to this owner capital. So he had $30,000 in his capital account before. Now that we've closed those total amounts, of course, his equity has increased because we had a good period last year. So those are the final two steps that I said we'd cover here. 8 and 9, right? Close those temporary accounts and, of course, prepare that post-closing trial balance. Step 10, we will never learn. It's an optional amount where we create reversing entries for the next period. Don't trouble your mind. If you're interested in learning them after this semester, give me a call and I'll be happy to instruct you on what it is. But for now, we've learned an entire accounting cycle. Like I said, the most important parts are from the most difficult and foundational parts are from Chapter 2 and Chapter 3, which is everything from Step 2 to Step 7. So please focus on those. This chapter should be a nice, easy one, but if you don't have Chapter 2 and 3 down, you can't understand Chapter 4, and you'll probably have difficulty understanding anything we do in the future. Enjoy.